Welcome to the Lion's Share podcast, where we break down today's most impactful research and bring fresh insights from the academic frontier straight to you.
You know, I was looking at this stack of documents we have for today, and I had this kind of realization.
Oh, yeah.
We spend so much of our time, and frankly, the show's time, obsessing over the sexy parts of building a business.
Product market fit.
Product market fit, disruptive innovation, viral marketing loops. We treat the venture like it's this high-performance race car we're building.
Of course. It's the fun stuff. Everyone wants to talk about the horsepower of the engine.
Exactly. But, and this is what hit me while reading through this stack of guides on business entity definition types and foreign entity registration, we usually treat the actual legal structure of the business as just a boring administrative afterthought.
Paperwork.
It's just paperwork.
Yeah.
Something to get out of the way so we can get back to the real work.
And that right there is the classic fatal mistake. If you want to stick with that race car analogy, which I love, by the way,
Go for it.
Think of the legal structure, not as the paperwork in the glove box, but as the chassis itself. You can put a Formula One engine, that's your high-growth innovation, into a vehicle. But if you've bolted that engine onto a go-kart chassis, which is essentially what a sole proprietorship is, the moment you hit the gas, the whole thing is going to shake itself apart.
That is a terrifying image, but it sets the stage perfectly. Today on the deep dive, we are synthesizing, a pretty heavy stack of technical papers. We've got guides ranging from basic entity definitions to specific breakdowns on taxation strategies, and a really fascinating, frankly, slightly terrifying look at foreign entity registration.
Our mission today is to move beyond the how-to. We aren't just reading instructions on how to fill out a form. We need to analyze entity selection as a core component of business model innovation and risk management.
Right.
It's about strategy, not just compliance. We need to ask, is your legal structure enabling your business model, or is it actively fighting against it?
So let's start walking through this landscape. The sources paint a spectrum of options. On one end, you have what the Module 2 source calls the default setting, the sole proprietorship.
The sole proprietorship.
Right.
At the simplest form, as the source material notes, it costs almost nothing to set up.
Right.
If you start selling consulting services or, say, lemonade on the corner and you don't file any paperwork, congratulations, you are a sole proprietor. It's the path of least resistance.
But the text heavily implies that free comes with a hidden cost. It feels like a trap.
It comes with a fatal flaw regarding risk. Unlimited liability. This is the go-kart chassis.
Define that for us. What does unlimited actually look like in a worst-case scenario?
It means there is no legal distinction between you, the human being, and the business. If that lemonade stand accidentally poisons a customer, or, and this is closer to reality, if your consulting code crashes a client's database and they sue for damages,
Okay.
they aren't suing the business. They're suing you, your house, your personal car, your kids, college savings. It's all on the table to satisfy that debt.
Which brings us to the concept of the shield, or what they call the corporate veil. This is what we see in the other structures mentioned in the source material, the LLCs and the corporations.
Right. The LLC Limited Liability Company and the C Corporation are designed to create a separate legal existence. It's a wall.
A wall between you and the business.
Exactly. If the business fails or gets sued, the theory is that the damage hits the wall and stops at the business assets. Your personal life remains protected behind the shield. Implicitly, the research question these sources are wrestling with is, how does an entrepreneur optimize for that protection while balancing tax efficiency?
Okay, so if the goal is protection, everyone should just build a shield immediately. But you mentioned tax efficiency, and that seems to be where the complexity just explodes. Specifically, how does an entrepreneur optimize for that protection while keeping the IRS happy?
That's the tension. And that's where we hit the fork in the road, taxation. One of our sources, sole proprietorships to S-Corp, makes a huge deal out of the difference between double taxation and pass-through taxation. This is probably the single most important financial concept for a new founder to grasp.
Double taxation just sounds like something we should avoid on principle. How does that actually work mechanically?
It applies to the C Corporation, which is the traditional structure for big companies. Let's say your C Corp makes $100,000 in profit.
Okay.
First, the corporation pays the corporate income tax on that $100,000. That's bite number one. Then, the company takes what's left and distributes it to you, the shareholder, as a dividend.
And I assume I have to report that dividend on my personal taxes.
You certainly do. And you pay personal income tax on it. That's bite number two. The same dollar is taxed twice, once when it was earned by the company, and again when it was paid to you.
Which sounds terrible for a small business owner. It sounds like leaking value. So why isn't the C Corp extinct? Why do we still have them?
Scalability and investment, which we'll get to in a minute. But you're right, most small business owners want pass-through taxation. This is what you get with an LLC, a partnership, or an S-Corp.
How is the math different there?
In a pass-through entity, the business itself pays zero income tax. It files a return, but it pays nothing. That $100,000 in profit passes through the business directly to your personal tax return.
Okay.
You pay tax on it once at your individual rate.
And reading through the notes, there was a specific nugget about something called QBI, the Qualified Business Income Deduction. This felt like a major advantage for the pass-through crowd.
It is a massive detail. The source notes that since the 2018 tax changes, many owners of pass-through entities can deduct up to 20% of their qualified business income before they even calculate their tax.
Wait, so if I make $100,000, I'm only taxed on $80,000?
Essentially, yes. That effectively changes the ROI calculation for a founder. If you were a C Corp, you generally don't get that 20% deduction. So for a bootstrapper who is living off the profits of the business, the LLC or S Corp path is mathematically superior in most cases.
It's simple arithmetic.
It really is.
Okay, you mentioned S Corp. We have the C Corp with the double tax and the LLC with pass-through. But then there's this term S Corp that gets thrown around constantly. The source, Sole Proprietorships to S Corp, clarifies this, and I think I've been getting it wrong.
How so?
I always thought an S Corp was a separate type of business, like a totally different bucket than an LLC.
You are not alone. That is a very common misconception. The source is very clear on this. An S Corp is not a business structure. It is a tax election.
So it's a status, not an entity.
Precisely. You form a corporation or an LLC legally. Then you file Form 2553 with the IRS. You are basically raising your hand and telling the IRS, hey, I know I'm a corporation, but please treat me like a partnership for tax purposes.
So you get the rigid structure of a corporation or the protection of an LLC, but the tax benefits of a partnership. Why wouldn't everyone just click that button? It sounds like the best of both worlds.
Because it comes with handcuffs. The source highlights that an S Corp status has strict eligibility rules. An S Corp can have no more than 100 shareholders. And, this is the kicker, those shareholders must be human beings who are U.S. citizens or residents. They cannot be other corporations, partnerships, or non-resident aliens.
That seems like a major limitation if you're trying to build the next Amazon or Facebook.
It is a hard growth ceiling. Think about it. If you want to be acquired by Google, Google cannot buy your S Corp shares because Google is a corporation, and corporations can't own S Corp.
Right.
If you want to take money from a venture capital firm, they usually can't invest because VCs are typically structured as partnerships.
So the S Corp is great for cash flow businesses, dentists, consultants, agencies, but often fatal for high-growth unicorns.
Correct. If you file that S Corp election too early, and then suddenly you get a term sheet from Andreessen Horowitz, you have a massive legal cleanup mess on your hands before you can even take the check.
You're just creating work for yourself down the line.
A lot of work and expensive work. You have to dissolve the election and convert, which costs time and lawyers' fees.
Let's shift gears from the what to the where. We have a source here called Top 3 Best States to Start and Incorporate a Business. This is where we get into what I call jurisdictional arbitrage. You hear this advice at dinner parties all the time. Incorporate in Delaware. No, go to Nevada. It's cheaper.
Ah, yes, the Delaware myth. The source breaks this down really well.
Why is Delaware the gold standard? I always assumed it was because they had the lowest taxes, but the source suggests it's something else entirely.
It's not about taxes, it's about the Court of Chancery.
The Court of Chancery, that sounds like something out of a Dickens novel.
It does, doesn't it?
Yeah.
But in business terms, it's a superpower. In most states, if your business has a legal dispute, say shareholders fighting over the board of directors, that case goes to a general court.
Right.
You might get a judge who handles divorces in the morning and traffic violations in the afternoon, or worse, a jury of random citizens.
And a jury probably doesn't understand complex corporate bylaws or fiduciary duty.
Exactly. But in Delaware, the Court of Chancery only hears corporate cases. There are no juries. The judges are experts in corporate law. If you are a VC investing millions, you want predictability. You want to know exactly how the law will be applied.
So that's the real product.
That is why half of the Fortune 500 is in Delaware. They're paying for the legal system, not the tax rate. It's a risk management play.
Okay, so Delaware is for the big players and the VC-tracked startups, but what about Nevada and Wyoming? The source paints them as the Wild West alternatives.
Nevada is the privacy play. The source mentions they have no state corporate income tax, no franchise tax, and this is the big one, they do not require you to list the owners or directors on public filings.
So if I want to remain anonymous, maybe I'm launching a controversial product or I just hate spam mail, I go to Nevada.
Theoretically. And then you have Wyoming, the underdog. I love that the source mentions Wyoming actually invented the LLC in 1977.
I did not know that. 1977.
First state to do it. Wyoming is essentially the low-cost leader. The annual report fee is under $100. It's very attractive for a small, bootstrapped startup that just wants asset protection without the high fees of Delaware or Nevada.
Okay, so here's the scenario I want to pose to you, and this leads us into the foreign entity registration source. This document honestly felt like a horror movie script for entrepreneurs.
It's where dreams go to die, yes.
Yeah.
It's the most common trap.
Let's say I live in California. California has high taxes, high fees. I read these articles and think, I'm smart. I'll incorporate in Nevada to get that privacy and zero tax, but I'll keep working from my laptop in my apartment in San Francisco.
You have just walked right into the doing business trap.
Explain the trap.
The source, What is Foreign Entity Registration, is crystal clear on this. You are considered a domestic entity only in the state where you form. So you are domestic in Nevada.
Yeah.
In every other state, you are a foreign entity.
Foreign sounds like international, but here it just means out of state.
Correct. And here is the rule. If you are doing business in a state, which includes having an office, employees, or even just generating significant revenue while sitting in that state, you must register as a foreign entity.
So, in my example, if I live and work in San Francisco.
California says you're doing business in California. It doesn't matter that your paper says Nevada. Your butt is in a chair in San Francisco. So you have to register your Nevada LLC as a foreign entity in California.
So I pay the Nevada fee, and then I also have to pay the California fee.
You end up paying both. You haven't saved money. You've doubled your administrative burden. You have to file annual reports in both states. You have to pay franchise taxes in both states.
And looking at the fee list in the source, these costs aren't trivial.
Not at all. Texas charges $750 for foreign registration. Tennessee is $615. Massachusetts is $520.
And Utah is only $59. It varies wildly.
It does. But the cost isn't even the biggest risk. The source explicitly warns about the consequences of failing to register. Let's say you try to fly under the radar. I just won't tell California.
What happens? Do they just send a bill?
If you are lucky. But the real danger is legal standing. If you aren't registered, you generally cannot defend a lawsuit in that state.
Wait, so I can't even hire a lawyer to say I didn't do it?
Think about what that means for your business model. You set up this entity to protect your assets, the shield we talked about. But if you get sued in a state where you're doing business illegally, the court can say you have no standing. You might be barred from using certain defenses. You could face fines and back taxes.
So you've just destroyed your own shield.
Essentially, yes. By trying to be clever with jurisdiction to save a few bucks, you might have poked a hole in your own liability shield.
That completely defeats the purpose of forming the entity in the first place.
Exactly. And there's another layer to the privacy illusion in Nevada. If you register a foreign entity in your home state, you usually have to provide a certificate of good standing from Nevada and list your registered agent. The paper trail eventually leads back to you.
So it's not really private.
For a local coffee shop or a consultant working from home, forming in Delaware or Nevada often adds complexity without adding any real value.
This raises a real tension between theory and practice. You see this advice online constantly. C Corp for everyone, go Delaware. But based on these sources, that seems like overkill or even dangerous advice for a lot of people.
It is the cargo cult mentality of entrepreneurship.
Yeah.
People mimic what successful startups do. Facebook is a Delaware C Corp, so I should be too,
Yeah.
without understanding the why.
Right.
If you are a lifestyle business or a consulting firm or even an early-stage venture that isn't seeking immediate venture capital, the C Corp is administratively heavy.
Yeah.
You have bylaws, annual meetings, board resolutions, and that double taxation we discussed.
Whereas the LLC is more flexible.
The LLC offers what we call dynamic capability. You can start as an LLC. You can be taxed as a sole proprietor or partnership. Then, if you start making enough money where the self-employment tax is hurting you, you can file that Form 25-553 and elect S-Corp status. You evolve.
But let's play devil's advocate. I start as an LLC because it's easy. 2 years later, a VC comes along and says, we want to invest $10 million, but we only invest in Delaware C Corp. Am I screwed?
No, you can convert, it's a process, but you can convert an LLC into a C Corp. It happens all the time. However, the reverse going from a C Corp back to an LLC is a nightmare.
Why is that direction harder?
Because the IRS views it as a liquidation event. If you dissolve a C Corp to become an LLC, the IRS treats it as if you sold all the assets and distributed the cash. You could get hit with a massive tax bill on phantom gains.
So the door opens one way much easier than the other. Start flexible, rigidify later if you need to.
Exactly. Don't wear a tuxedo to a gym workout.
I want to circle back to one small detail that the how to register a business source mentioned, which connects to this foreign entity issue. It talked about the registered agent. I feel like people just click a box online and pay $50 for this. What is the actual functional role of the registered agent?
It's the point of contact for the legal system. It is not your mailing address for Amazon packages. It is where the process server goes. If you get sued, they don't hunt you down at a coffee shop. They deliver the papers to your registered agent.
And the source notes that you need one in your state of formation and in every state where you are registered as a foreign entity.
Right. So if you are a nationwide consulting firm with employees in 10 states,
I need 10 foreign entity registrations and 10 registered agents.
you likely do. That administrative cost scales linearly with your geographic footprint.
This is where the remote work revolution becomes a minefield.
Oh, absolutely. Everyone is hiring remotely now. You hire a developer in Colorado, you think, great, I'll just send them a laptop. But legally, you have likely just created Mexis in Colorado. You are employing someone there. Technically, you should register as a foreign entity in Colorado.
I would bet money that 90% of startups ignore that.
They do, until they get hit with a fine or a payroll tax audit.
Yeah.
And then they realize their simple structure isn't so simple.
This conversation really highlights how the legal structure isn't just a box to check. It's a signal to investors, it's a tax strategy, and it's a risk management tool. It feels like we are creating a taxonomy of venture failure modes here.
If we synthesize all these documents, we see a pattern regarding the venture life cycle. Stage 1 is bootstrapping. You care about cash flow and tax efficiency.
Right.
The LLC or S Corp is king here because of pass-through taxation and that 20% QBI deduction.
In stage 2.
Stage 2 is high-growth exit. You care about investment efficiency and tradability of shares. This is where the Delaware C Corp shines. It's a standardized product that investors buy without reading the user manual.
And if you use the wrong structure at the wrong stage, like an S Corp when you're trying to IPO, you hit a wall.
The S Corp limit of 100 shareholders is a hard wall. You literally cannot go public as an S Corp. You'd have to restructure everything.
So let's crystallize this for our listeners. We've walked through the definitions, the tax implications, the state choices, and the registration traps. What are the key takeaways from this stack?
First, don't DIY blindly. The How to Register source emphasizes consulting a professional because mistakes are expensive. For example, that S Corp election form 2553 has a deadline. Usually 2 months and 15 days after the start of the tax year. If you miss it by a day, you're stuck with the default tax status for the whole year.
That's a painful mistake that costs nothing to avoid if you just know the date.
Second, watch your nexus. As we discussed, hiring that remote employee isn't just an HR decision. It's a legal structure decision. It triggers foreign entity requirements. Don't let your hiring strategy outpace your legal compliance.
And third,
the pivot option. Remember that you can evolve. You don't have to build the Formula One chassis on day one. An LLC gives you the flexibility to pivot your tax status to S Corp or your legal status to C Corp as the business model validates itself.
It's about matching the legal life cycle to the venture life cycle.
Exactly. Don't over-engineer it too early, but don't ignore it either.
I want to leave everyone with a final provocation, something that struck me while reading the section on the corporate veil. We often think of innovation as product or marketing, the stuff customers see. But true corporate entrepreneurship involves innovating the entity itself to maximize value capture.
That's a great point. The structure is part of the product.
Think about it. Is your legal structure enabling your strategy, or is it just taxing it? If you're paying double taxes when you don't need to, or if you're paying foreign registration fees in 5 states because you didn't plan your hiring, your structure is actively eating your profits.
It goes back to the car analogy. You can have the best driver and the best engine, but if the chassis is dragging on the ground, you aren't winning the race.
So open up those formation documents, look at where you're registered, and ask yourself if the chassis still fits the engine. Keep analyzing, keep building.
And keep it legal.
Thanks for tuning into the Lion's Share podcast. If you enjoyed today's discussion, share it with a friend and join us next time for more ideas worth talking about. We'll see you next time.